I'm going to start off with our M Live question of the day, and that is, at the moment, and to what extent is inflation and are inflation risks priced in?
Well, I guess it depends which asset class you look at. I mean, if you look at, inflation expectation markets, which is about as close as you can get between markets and the underlying sort of economic variable, actually, they seem relatively calmer than some of the headline inflation rates. So arguably, the markets seem to have the view that we've got, obviously, the temporary rise in inflation, but, maybe less room for upside surprise here. And to an extent, that feeds into our view that if you look at what's happening on inflation, whether in China or elsewhere, a big part of it is still statistical. The other part of it is, more supply chain or supply side driven in nature. But none of those really feed into, the risk of a big monetary policy response. And indeed, both of those feed into the view that, look, this rise in inflation could be short lived. And if anything, we could be, in second half of the year and see inflation numbers a lot lower. So I think that's where markets appear to be, particularly look at inflation expectations. And that's part of the reason where we're coming from a view that, yes, inflation is hard to price, but actually it leads to a policy environment, that may still end up being quite a supportive one. We don't think policymakers are looking to slam on the brakes just yet.
Well, absolutely, and I think you'd probably concur with Jeffrey Gundlach on this, the billionaire money manager. When asked whether inflation would be transitory, he replied saying, how does anybody know? I guess, we're all in that camp, aren't we? And perhaps we're getting ourselves into a bit of a twist about it all. And I suppose, again, it goes to this narrative that a bit of inflation is a good thing. And this is a situation where good news is bad news because interest rates are likely to respond.
Well, absolutely. And I think this is a good example of where, look, we know inflation is historically been a very difficult variable to forecast. So while we might all have a view, it's a good example where the investment strategy is much more important than the forecast. And when we look back at history, actually equity markets have tended to do quite well as long as growth, not inflation, but growth actually keeps on improving. And I think that's the key here, that equity markets have outperformed cash and bonds when growth has been rising. And it's really, you start seeing the underperformance only when growth starts falling, regardless of whether inflation is rising or falling. And the other way to look at it is, look, equities have delivered, reasonably positive returns, even in high-ish inflation scenarios, with CPI, let's say, in the region of 2 to 3%. So when you're thinking about planning for a range of scenarios, there's one scenario which is a baseline view that inflation is transitory. Actually, bond yield should be reasonably contained. Equities do well in that scenario. But even if we're surprised a bit modestly on the upside, equities are still a good place to be. It's only if you start seeing an unexpected surge in inflation, that's really where one needs to reach for commodities as more of a hedge.
But that's just it, Manpreet. It does seem like equities are priced for perfection. Global stocks close to record highs right now. Bring in the risk from geopolitics. We have the U.S. now saying that, it will be on par to compete with China. How will this play out? Which risks, which asset classes are most at risk?
Well, I think getting the mix right is important in that context. And I absolutely agree with you. The kind of gains we've seen in equity markets, you have to ask, how much is price. But then you look at the flip side where you say, look, equity markets, you ultimately pay for future earnings. And in regions like the euro area, which we recently upgraded, earnings expectations are in the region of 50%, which is difficult to ignore either. Yes, variety of one-off reasons, but that's still a very big number. So I think there are a number of balancing factors here. So in our view, the best way to play this is equities, but with a preference more for value sectors as opposed to growth. That's one way within the equity space to obviously manage that. The other is sort of mixed balancing it with the position with gold. So, if we do get inflation that's even a little bit higher, a little bit longer lasting than we expect, high inflation means lower real yields, and that's, good for gold, even if those gains are front loaded. So that's one good hedge. And even within the corporate bond space, we've seen massive gains in asset classes like high yield. When you start looking outside of the US, that's where you start to see a bit more value, particularly in emerging market dollar-denominated bonds. So there are a few places to look around the world which should match both the economic inflation scenario, but also where you might see a little bit more value.
And Manpreet, I want to start with Chinese bonds. A lot of call for a bond rout since March, but we haven't seen that yet. When do you expect that to happen?
Well, I think we need to dig a little bit deeper. I think China's sort of dollar-denominated bonds as well as locally bonds. We've been through obviously, many moving parts. I think on local bond yields, some of it comes to the growth outlook a lot, also on the inflation as we were discussing earlier. But I think the real sort of action for us, of course, happening in the dollar-denominated corporate bond market. And I think there, obviously, we still favor the high yield component. You see a lot of value when you start comparing current valuations relative to what you can get in developed markets, particularly in the US, of course, in the US and Europe. And within that, of course, we're seeing, fundamentals arguably holding up. Some concerns, of course, coming through from the state-owned credit quality, but we see more and more of those priced and arguably impacting the high yield less so. Many of those concerns, of course, within the investment grade sector. So in a environment where yields have stopped rising, we still think, Asia in dollar-denominated corporate bonds, particularly the high-yield segment, alongside, the broader EM universe, that's really where one of the areas we still see a lot of value.
How concerned are you about any kind of contagion? We've seen how the government is asking banks to do stress tests on their exposure to Evergrande, for example.
Well, when you talk about the property sector, in high yield, I mean, it's, there's sort of firms being pushed to two extremes. And a lot of this comes down to, the prior policy of the three red lines. It's inevitable that there'll be some individual, examples which, fail to improve. And I think that's where, we've seen some of the stress, at least at the sort of smaller firms. But what's interesting is that, look, the sector in aggregate, we've seen much more of a shift of number of firms towards, higher credit quality. So compared to the end of last year, we've seen many more firms, sitting in the green category or the yellow category compared to where we were at the end of 2020. So yes, of course, there'll always be individual challenges, and I think individual sort of bond selection is important. But at an aggregate sector, we've actually seen improvement in underlying credit quality, and that's one of the reasons why we're positive on the sector still, over the next 6 to 12 months, and that sort of feeds into our positive view on high yield, given that is one of the largest sectors in Asia, high yield.
Manpreet, we look at vaccine rollouts around the world, and it's caused a bit of consternation in at least this region. Tell us, has that played any part in your equity strategy? In which case, do you look at Europe more favorably in the US rather than what you're really seeing here right now?
Well, the net change absolutely is important, because if you look at the US, for example, when we talk about economic normalization, the pace of vaccination, that's undoubtedly been one sort of precondition for that. And I think where we've seen the biggest net change has been in Europe. Because we had expectations. We, of course, had a double dip as sort of, new COVID waves came through. But what's changed over the past month to month and a half is that the pace of COVID vaccinations has really accelerated on a daily basis. So on a daily vaccinations per 100, for example, the euro area is now on par with that of the UK, actually a little bit ahead of the US, as the US sort of rate has slowed. So in our view, when you think about economic normalization, some of that potential, earnings upside coming through, that's almost the base, the precondition. And I think euro area is where we've seen the biggest net change. And that's part of what feeds into our view. I mean, there are the usual earnings, valuation fundamentals, but that's, the biggest net change that's improved our view, with euro area, of course, alongside the UK. So euro area equities is one of the preferred regions and the way we play on that view.